Yesterday, we saw the president essentially approve the largest stimulus checks that we have seen so far, targeted directly to the wealthiest among us, to the big banks, to the big businesses, and to some pretty big depositors. Now, I didn't go into too much detail yesterday when the president made his announcement that they were going to be helping out the banks and what was unfolding, but today I want to dive a little bit deeper, because in that speech, people were saying, listen, the president said it's going to be okay. Come on, man, don't worry about it. You're blowing it up too much. Well, I want to dive into some details, and also the president said that the taxpayers, the average everyday American, should not worry about this because you're not going to fit the bill on this one. Well, in today's video, I want to cover some details for you as to what's actually unfolding, what has taken place, what a lot of people are still concerned about that we could see coming here, and just even how all of this started with the banking system. So I want to dive into some of the details for you so that way you can know what's going on. Now, in addition to that, if you're wondering, what about the low-income individual? What about them getting a bailout and some stimulus checks and some additional assistance? Or maybe you're thinking, you know what about the people that are going to collect Social Security, that have paid into it their entire lives, and now we're being told there's not enough money for that, and we haven't gotten that boost that we were promised of $200 per month? Well, if you're interested in those, I recommend that you hit the subscribe button, turn on the notification bell, because I'm going to keep you up to date on this channel on everything happening in Congress with our economy, so you know what to prepare for or what is available for you and your family. And if you appreciate that, do me a quick favor before we dive in, smash the like button. Just takes a second, helps out the channel a ton. But let's take a look at this. Hopefully I can piece these together, stick around to the end. Hopefully it all makes sense as we connect the dots on what's happening right now with our banking system. All right, so let's start right here. At the end of 2022, the FDIC reported that its Deposit Insurance Fund, or the DIF, had a balance of $128 billion, which is roughly about 1.27% of the total insured deposits. So when you put your money in the bank, they will insure it to up to $250,000. So $128 billion covers roughly about 1.25% of everything that's needed. Now, here's the issue though, is that this bank that went down, Silicon Valley Bank, about 90% of its depositors exceeded that $250,000 limit. This was a big bank for big investors. So there was a lot of people that lost a lot of money in this until the federal government stepped in on Sunday. Take a look. The U.S. Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and the FDIC, they all came together and said the government would back the Silicon Valley Bank deposits beyond the federally insured ceiling of $250,000. So if you had $10 million in there, don't worry, you're gonna get it all back. They use the term, we will make you whole. The decision addresses concerns about the fate of the uninsured funds held at the Santa Clara, California-based bank, the country's 16th largest bank. So just to clarify, this is a major institution. This is not a small bank that's collapsing, which had about $209 billion in assets, and listen to this, more than $175 billion in deposits. So right there alone with this one bank, those deposits exceed what is currently in the DIF. So now the question becomes, when we fully deplete what the FDIC has in reserves to go ahead and help out, what happens next? And that is where we're going to get into a little bit more detail. And this is the route that we're going. Just to clarify, take a look. In a joint statement on Sunday, Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and Federal Deposit Insurance Corporation Chairman Martin Gruenberg said that the FDIC will make SVB and Signature customers whole. You will get all of your money back. Now, by guaranteeing all deposits, even the uninsured money that customers kept with the failed banks, the government aimed to prevent more banks from having a run and to help companies that deposited large sums with the banks to continue to make their payroll and to fund their operations. So they have successfully, hopefully, what they're thinking here is stopped runs on banks, because like I said in yesterday's video, it's a dominoes effect. So if one goes down, it's connected to another one. People start going to that one, they're concerned, and we start seeing all these runs on the banks and they start shutting down. And this could be a major issue, because I'm going to explain to you in a second here towards the end how the banking system works. So where do the funds come from, and what happens when we run out? Well, take a look here. The FDIC is not supported by public funds. So yesterday when the president said that this was not going to be hitting the taxpayer initially, it's kind of accurate, but we're going to get a little bit more into this. Member banks' insurance dues are its primary source of funding. When dues and the proceeds of the bank liquidations are insufficient, It can borrow from the federal government, though, which is the territory we're going into. Now, how are they going to borrow that, and how much are they going to borrow? Well, the FDIC Reserve Fund has never been fully funded. As a matter of fact, we just saw it had $128 billion, which was about 1.25%. So this is accurate. In fact, the FDIC is normally short of its total insurance exposure by about 99%. Congress granted the FDIC, listen to this, the power to borrow up to $500 billion for the Department of Treasury, making the system effectively backed by the Federal Reserve. So, in other words, if they use all those funds, which they're about to do right now for SVB, they can get a line of credit essentially from the federal government. Now, take a look directly from the FDIC. They maintain the Deposit Insurance Fund, or the DIF. Now, you're going to get it here just a second. Bear with me through these two paragraphs, which is funded by premiums paid by the banks. The FDIC uses this fund to pay out insured deposits when a bank fails. If the DIF does not have enough money to cover the insured deposits of the failed banks, the FDIC has access to a line of credit. We just heard $500 billion with the U.S. Treasury to make up the difference. Now, in general, it is the responsibility of the banking industry to fund the FDIC and to ensure that it has sufficient resources to protect depositors in case of a bank failure. So we heard the president say, taxpayers, you don't have to worry. But while the failure of the bank can be a significant event, the impacts of the taxpayers is generally limited to the amount of money they contribute to the government through taxes, which may indirectly support the FDIC. However, the FDIC has generally been able to cover the insured deposits of failed banks through its deposit insurance funds without needing additional funds from the taxpayers. And at this point, they are depleting all those funds. They're going to have a line of credit, which is coming from the federal government. Now, in addition to that, what happens if more banks go down? Let us hope that that does not happen and they exceed that line of credit. So at this time, there's a lot of people concerned right now about this, and they're not exactly trusting what the president had to say because, yes, it is technically coming from the FDIC and their DIF fund, but we are now exceeding that, depleting that, and they're going into a line of credit that is held by the Treasury. Now, why did this all happen? Well, it's because of the way that the banking system is structured, which I'm going to cover for you. And I'm going to do this very basic and simply. And I know these are not all the numbers or all the details, but I just want to explain this very simply. And I know the vast majority of people probably already know how this works. But let's do this as A, B, C. So let's say that there is Abby, I'm the bank, and then there's Charlie. Abby comes to me, the bank, and says, I've got $100 I'd like to deposit. And I say, thank you, Abby, for you trusting me with your $100 every year. I'm going to give you interest. I'm going to pay you $1, 1% interest. And I know that is not the actual numbers, but just for simplicity's sake, let's say that every year, me, the bank, I'm going to pay Abby $1. Now, Charlie comes to me, the bank, and says, I'd like a loan. Well, I've got $100 sitting there. I'm allowed to lend out 90% of that. So I say, I've got $90 that I can loan you, Charlie. Charlie says, yes, I'll take it. And I say, but you got to pay me 10% interest on that loan. And he says, yes, okay. So that means every year Charlie is going to pay me $9. And every year I have to pay Abby $1. Welcome to the banking industry. That is pretty much how it works. Now, just multiply those Abbies and Charlies times thousands and tens of thousands, and maybe add about 6 to 9 zeros on the ends of all of those numbers. Welcome to the banking industry. So, here's the issue, is that if all of the Abbies suddenly decide that they want their $100 back, guess what? I've only got $10. I lent out 90% of all of the money out to the Charlies. So the last thing that a bank wants is all of the Abbies showing up all at once saying, I need my money now, all of it right now, taken out, because they actually don't have the money. By them lending out at a higher interest rate, that's how the banks make their money. And that is exactly what happened to Silicon Valley Bank. And as a matter of fact, it's been happening since last year. It's been happening for a while, and they were hoping that the tides would turn, but they didn't. And they started having to pull their funds out of the bank all at once, and it started going more and more until the point where last week, finally, things came down to a crashing end. And that also sparked fear in other banks, and we also saw other dominoes happen with Silvergate and with Signature, and other people are wondering if it's going to be happening to theirs. So that is why the worst thing that could happen to a bank is for all of the Abbies to start withdrawing all of their funds all at the same time, and that is why they had a collapse. So hopefully that clarifies things. Now we're going to be seeing what unfolds here. I do not think this is the end of it. Just to clarify, I think that we're going to be seeing more unfolding here from the Biden administration. We're going to be hearing from the Federal Reserve, from the Treasury. We're going to be seeing what takes place and if there are any other banks that have any more announcements. I will keep you guys up to date, but that is the latest. And yes, this is massive, huge news. This is not something small. This is a mega bank that is collapsing and the federal government stepping in to help out all the depositors, essentially giving out some of the biggest targeted stimulus checks to the wealthy that we have seen so far. So that is the latest. Let me know your thoughts in the comments down below, and also check out this video next if you missed it to get caught up on more news. I'll see you in the next video. Don't forget, like, subscribe, take care, God bless. This is Steve.